Good morning from London. This is Bloomberg Markets. Today I'm Guy Johnson alongside Tom Mackenzie and Lizzy Burden with equity trading. Less than half an hour away, less than an hour away. I want to get that one right. What do you need to know this Monday morning? Markets are on tenterhooks ahead of Wednesday's hugely consequential inflation print out of America. The auto sector is also in focus this morning, with President Biden expected to hit Chinese EVs with 100% tariffs this week. Watch European green energy stocks at the open as well. Donald Trump vowing to hit offshore wind investment if he is elected president. And Emmanuel Macron's Choose France event gets underway at the Palace of Versailles. The French president will join Bloomberg TV later today, Tom.
OK, the market check then. It's been a volatile session over in Asia with the data coming out of China. Look ahead, of course, to the inflation print out of the US, all the data that comes through this week as well out of the UK, Germany as well. There's EDW sentiment survey. Currently, European futures pointing to gains of 0.2% after notching a record on Friday. 8,438 is the picture on the FTSE 100, flag lower by a little over 0.1%, 449 on the 10-year. Not a lot of movement so far in treasuries, but of course that could all change on the inflation story later this week. 107 currently on euro dollar on the single currency. The show, Markets Today, starts right now.
Monday the 13th of May, good morning. We've got a busy week. Today, quiet. Today, we're waiting. We're waiting for the inflation data that starts to pick up a little later on today, you could argue, with the New York data. But then we get into Powell on Tuesday. And then the key event, Tom, is later Wednesday with the US CPI print.
With a focus on core and as to do we get back to a disinflation narrative? And we've been talking about that over a 3-month period. Year to date, 4.5% if you aggregate it for core CPI versus 3.3% in the US in the fourth quarter. So that change, that move up in core is, of course, is what's been the concern. Does that theme start to change? And what does that do to the narrative that you're getting from those officials? They all seem to be of the view that you can hold higher for longer. The view from some that you may not get a cut this year at all.
Lizzy doesn't care about any of that. Lizzy cares about one thing this week, and that's Hugh Hill speaking tomorrow.
Yeah, I mean, I want to get some clarity on when that BOE rate cut's coming. We didn't really get it last week. We found out which data points we need to look to, which, to just come back to the US data point, means you're going to get even more volatility around every single data point that we get. There was all that attention on the University of Michigan survey that perhaps you might not have had on Friday, but pointing to, inflation expectations picking up, and so kind of knocking the stock rally last week.
I thought the University of Michigan data was largely ignored, which I found surprising considering it basically pointed towards stagflation. You had kind of weak growth, but the consumer's beginning to latch onto this idea that inflation is picking up, but the growth outlook, kind of confidence outlook, is not quite so good. But it was interesting that the market ignored that. Usually that's quite a consequential piece of data. But we're looking forward into the inflation data this week. And it's a kind of slow build-up to Wednesday.
And that's the problem around wages, because we've seen the hourly average wages, the hourly average earnings in the US start to soften in an environment where you still have very high inflation and prices, and that is going to challenge the consumer. The other really interesting detail and data I think we're going to get this week as well is the retail data out of the US, and that's on Thursday. So in terms of that health of that consumer, because we know that those pandemic savings have dried up now. So at what point does the retail and does the consumer in the US start to crack?
OK, let's talk about what the week ahead ultimately looks like. Euro finance ministers meeting in Brussels. I think they meet later on this evening, and then they've got the big meeting coming up tomorrow. We, of course, got the Choose France summit, which is taking place today, tomorrow. We've got some great interviews lined up coming out of that event. We are going to be hearing from the French President, Emmanuel Macron, a little bit later on. Final German CPI data. You've got the Qatar Economic Forum also kicking off this week. Some great interviews coming out of that. Chinese earnings, Tencent, Alibaba, Wednesday, Euro area first quarter GDP. Got the Russian President, Vladimir Putin, beginning his trip to China. He's made some pretty big changes in terms of his cabinet over the last 24, 48 hours. The US CPI data is going to be coming up, and that really is going to dominate earnings from Walmart, Siemens, the NATO military chiefs meeting in Brussels on Friday. Lots of Chinese data as well we need to be digesting too. But it is basically that slow build-up. Today you get the New York inflation expectations numbers. Powell's in Amsterdam tomorrow, along with Klaus Knot.
Yes. So giving a speech before, of course, the inflation data comes out. So to what extent he's going to be kind of caveating his message? He's slightly hemmed in by the fact that we don't have this inflation print by the time he speaks in Amsterdam. And again, we had this. Does he walk back? Does he reiterate that view, that expectation that a hike is very unlikely this year? And to what extent is this now a Federal Reserve that's leaning on the jobs part of its mandate versus the price growth part of its mandate?
I think it's really... I don't know yet. I think this week is going to... I think the inflation data... We focused on the price, the jobs data because we've had the jobs data. Now we get the inflation data. Let's see if that's actually true.
Yeah, look, half the jump in the 10-year yield this year has happened on CPI days. So this data has a really outsized influence on bonds. As I say, it comes back to so much volatility around every single inflation print at this point, and you'll see that even more so in Europe and the UK because of the emphasis that Lagarde and Bailey have put on their prints.
The other piece of data I think we should watch out for this week is the NFIB data, the small business data. This is the backbone of the US economy. If they continue to struggle. So the last data showed actually some concern about what was happening with the growth outlook, but there's still this kind of the underlying, we can't kind of recruit the people that we want, but still there is evidence, to Tom's point about the labour data, there is evidence that actually small businesses are beginning to become a little bit more circumspect in their desire to hire. Yeah,
and of course we will have the retail sales data, which comes back to the question of how much excess savings are still there and have they finally been expended? Was March the month when actually they ran dry?
Well, we should have a much clearer picture in terms of the health of the US consumer, because not only do we get that data, as you say, really important, but also the earnings as well from the likes of Walmart that have that touch, of course, across the US consumer. So maybe they will give us some sense as well as to whether that resilience is still there, whether people are trading down, and to what extent that builds.
So how do markets... Lizzy's made the great point that actually you get really big moves in this data for markets. So, this is hugely consequential. John Authors has written a nice piece this morning talking about how consequential it is. You get big moves around these numbers. We back down. We're getting to around 450 on a US 10-year. We're just slightly shy of that. Is that the extent of the move? Do we go further on that move if we get a weak print this week? And how asymmetric is the risk? We've come down, therefore is the risk actually the greater risk for markets to the upside? It kind of feels like slightly the risk is asymmetric around the print. I don't know. How do you position for that?
Well, Mark Cranfield from the MLIV team saying that it's really the FX space that reacts most aggressively on the back of this CPI print initially. He says equities are relatively immune, given that there's this focus on AI and that component. But it's interesting, obviously, when we look at the FX space, so you look at the dollar, do you back up into the dollar a little more in the lead up to this inflation print out of the US?
So we're going to be minding all that eco data coming out this week. All the earnings, as you say, Tom, as well. Lots of big tech names reporting in Asia. But choose the Macron Choose France summit happening as well. Really exciting. We're going to have a big interview with the French president and our editor-in-chief, John Micklethwaite. So many questions to ask him, but I think it's interesting that this conference has been going on for several years. 7 times it's happened, and there are huge names that come back every year, enjoy the wine, enjoy the food, and they still fail to invest in France. Elon Musk, to name just one.
But there are some big investments that are happening around this. Like Pfizer's going to make a big announcement. Morgan Stanley, according to Bruno Le Maire, is making a big announcement. The French banks, though, are getting a little bit more cautious. So the labour market data, the labour market story around France and how inflexible you could argue it is starting to have a meaningful impact on the big banks' desire to put more people to work in France. And I wonder whether we're going to get pushback today. We're going to hear from David Solomon a little bit later on to get his take on this. So are the French banks, are the banks worried that France has not gone far enough and held up its side of the bargain?
Well, that's really interesting, isn't it? Because, of course, Macron has been focused on trying to make the labour market a little bit more supple and flexible. But, of course, he faces that historic pushback from unions and other political parties as well. So he has made some progress on that front, but as you would say, France is still a long way away from the kind of labour market flexibility that you get in the UK.
Yeah, and post-Brexit, Paris really a beneficiary, the main beneficiary of Brexit, and yet still not managing to catch up with, London, New York, potentially because Macron hasn't been successful enough when it comes to burning that regulatory red tape.
There's another factor I've thrown here as well, which is the UK banker bonus story. So no more limits in terms of what you can apply in terms of bonuses. Does that put London at an advantage here over Paris? Is that something that maybe the EU needs to deal with? Because this was ultimately a piece of EU legislation that got transposed into the UK. Well, the UK was part of the EU at that point. and now has been withdrawn, does that actually give London a competitive advantage, particularly when it comes to decision makers, the more senior people in those banks?
Well, yeah, and on the flip side of that, you've got French banks saying it's too hard to fire those ultra-high-earning traders and investment bankers, which was making Paris not as attractive a place as it could be.
Deutsche Bank CFO speaking about that.
Yeah, he was, wasn't he?
And he said this is a potential competitive threat, the changes around the bonus cap in the UK to continental Europe.
Bloomberg's got it all. I have to say, over the next few days, we have absolutely got it now. It's got the French president today. You've got the Goldman Sachs CEO coming a little bit later on. John Ferro's going to be speaking with him. We've also got an interview with the US Treasury Secretary, Janet Yellen. That conversation kicking off a little later on today, 3 p.m. UK time. Pay attention to this one. We're really focused on what is happening with the monetary side of the equation this week, with all the data we're getting and how the Fed's going to react and Powell. But in some ways, Janet Yellen is at the epicenter of the action. This is a fiscal story in the United States, and that is what is the power behind the US economy right now. How much longer does it continue to be? Well, you want to tune in a little bit later to hear what Yellen has to say.
Meanwhile, in the Middle East, the focus is going to be at the Qatar Economic Forum, as well as, of course, what continues to unfold in Gaza. But the QEF event is happening, of course, in Doha. 2024, it's going to start tomorrow. We're going to be speaking to global political players, such as the Qatari, Polish and Malaysian prime ministers, the Saudi finance minister and the governor of the Turkish central bank as well. So some obviously influential voices within that region. Of course, the geopolitical focus on Israel and Hamas and Gaza, but also around Turkey is interesting because they've started to adjust the monetary policy and fiscal policy tools that they're reaching for. And there's an argument from some. We were speaking to an EM credit analyst last week saying that maybe Turkey is a space you want to look back at as well. So that's going to be really important as well. QEF and some really big names coming out across this week.
OK, so interesting conversations coming out of the Middle East. But let's get back to the geopolitics, the trade relationship between the US and China. The Biden administration set to quadruple tariffs on Chinese electric vehicles and sharply increase levies for other key industries as well. Bloomberg understands that EV tariffs will rise from just over 27% to more than 100%. We can get more now from Bloomberg's Bill Farries in Singapore. Bill, what do we know about Biden's plans for EVs and solar, and when do we expect this to come out? Because we had this big Bloomberg scoop. What new details do we have?
Well, we do expect some kind of an announcement as soon as Tuesday in Washington, talking about this new range of tariffs, all increases, no decreases, on a range of industries, including EVs, as you mentioned, things like batteries. We've already heard about steel and aluminum, but there could be some other industries wrapped into this. The headline number that we know about for sure, the key detail, is this 102% tax on imported electric vehicles from China, up from about 27.5% now. Somewhat of a symbolic move in the sense that you can't really buy, you don't really see Chinese EVs on the U.S. market. But BYD has become, along with Tesla, one of the world's two biggest producers. There's a lot of interest in seeing that car exported by China to other nations, including the U.S. With a 102% tariff, that's not going to happen. There's also some information about the solar industry being hit with some tariffs, but perhaps not all the equipment that solar manufacturers, American solar manufacturers, need to get from China. There are other aspects of this that we expect to come out. We don't have all the details. What we do know is the big increase for EVs at this point.
Bill, great stuff. Thank you very much indeed. Bill Farrow is joining us on the EV story. Keep an eye as well on European green stocks. You saw Donald Trump over the weekend also talking about the idea that maybe he will wind that industry down or certainly reduce it were he to come into power. Coming up, we'll talk more about this massive day ahead of interviews that we've got here for you on Bloomberg Television. The French President Emmanuel Macron is coming up. The CEO of Goldman Sachs is coming up. We're going to hear from the Treasury Secretary, Janet Yellen, as well. That's why you tune in to Bloomberg Television. Up next, we're going to get back to the big market story of the week. It's about that inflation print Wednesday. Any questions? Please join us on IB+, BBTV Go. That's the function. This is Bloomberg.
There isn't, at this time, much evidence, in my view, that inflation is stalling out at 3%. if you take a step back, what's happened is inflation went way up in the United States and in everywhere else in the world.
The Fed's view from Austin Goolsbee. His view is very much more dovish than maybe the rest of the FOMC, but nevertheless, we're going to find out this Wednesday exactly what the inflation print is going to look like and how that view maybe chimes with what the data actually tells us. Bhanu Baweja, Chief Strategist at UBS Investment Bank, joining us now on set. What are you expecting this Wednesday? How consequential is this data? The data, we got a week dominated by inflation data. What's it going to tell us?
Look, I think we will see lower CPI, so I think the focus is going to be on core CPI. And just to put this in perspective, core CPI has been around 36 to 39 basis points per month for the last 3 months. We're going to see that decline to about 31 basis points this week, and so this is April CPI, right? And why we're going to see that decline is because vehicle insurance, which is one of the two items which has led to this massive increase in CPI relative to trend. So vehicle insurance is one, OER, owner equivalent rent, is the other. Yep. Vehicle insurance will begin coming down this week. OER, the leading indicators are telling us it's going to take a couple more months for that to come down. But by June, so this is April print, by the June print, you would probably see core CPI back below 20 basis points, which is the standard that the Fed would want to see. And at that point, I think Fed speak will completely change. So not imminent, but given what's priced in the market, it still makes sense to be received in the front end rather than paid in the front end.
So what's the lag between getting to 20 basis points or starting with a 0.2 and the Fed starting to cut rates?
Very little. I think the Fed's starting to cut rates probably September onwards. Okay. So that's probably a 3 to 4 month. I think what's going to be important is how the market begins to move. There's going to be very little lag, almost no lag in the Fed changing its tune. Yeah. And I think that's going to happen around May, June. So I think by the June print, which is going to be out in July, that's the time the Fed completely changes its tune. That's the time I think the big move in the 2-year begins. The Fed actually cuts only in September or potentially even in November. So this could be a much backloaded cut. But the move in the 2-year is likely to come before that because Fed speak is likely to change before that. Because remember, Guy, what's priced in the market is very little now. You've got less than 2 cuts priced this year. You've got about 2 cuts priced next year. So this year the market may not disagree with, but next year I think that's pricing in much too little. So the
big moves in the 2-year at the front end in June, July. In the summer, yields down, price up. What is the level of the move? What kind of levels are you looking at?
So I think you can see the 2-year down towards 4%. Right. So right now we're trading at 485. We could actually see by the end of this year 2-year down towards 4%. I think the 10-year will probably lag. I think that will also come down, but the curve will steepen. In fact, the curve is likely to bull steepen with the 2-year coming down more than the 10-year. The 10-year, because obviously term premium does need to go up in this economy where you're getting this kind of fiscal stimulus. Even with the output gap positive, even with the unemployment gap negative, you're getting this level of fiscal stimulus. There should be high term premium, which means duration should not rally quite as much as the front end. But the front end, which is about monetary policy, I think that will change. I think the narrative in the last few weeks and months has been completely in the opposite direction. 5 was a very high sort of level, and the market's given that back, rejected it, come back to 480. I think we've got another 80 basis points to go.
So caps in the long end, to some extent, the gains in the long end to some extent capped by that need for premium and maybe the issuance story in the US. Just give us clarity in terms of how many cuts then you expect. You get 4% on the 2-year, a 4 handle on the 2-year. How many cuts is that? Is that 2, 3? Where do you land?
It's 2 cuts this year. 2 cuts this year, but next year you could see up to 5 more cuts.
Up to 5 cuts in 2025.
Absolutely right. So next year is where it's at, and so the 2-year rate is a 1-year, and a 1-year. So the 1-year, I think, is more wrong than the 1-year is.
I just want to bring the focus over to Europe because the divergence between the Fed path and the European path is perhaps one reason why you are now more favourable on European equities. How much is it because of the central bank story and how much of it is because of the earnings story that you've changed your view in this way?
So in Europe, I don't think the ECB is that mispriced at all. I think the ECB is being priced fairly correctly by the markets. If anything, I mean, there's a small possibility that the ECB doesn't move as quickly as what the markets are anticipating, and that's because wages are going to move much more slowly in this region. So growth is weaker in this region, but wages will come lower slowly because they're much more sticky. The labor markets in Europe are much more slow. There's greater inertia here. So there is a small possibility that the ECB actually doesn't move quite as quickly as the Fed does, and I think, quite as quickly as what is being priced. But I think the Fed is way more mispriced than the ECB.
What about the Bank of England? So after the last meeting, I think it's markets pricing about 60% chance of a June cut. Just more than a coin toss, is that right for you?
It is right. I think we will get a June cut. I think the BOE is moving in that direction. What's interesting is how long and gilts have reacted almost one-to-one with US Treasuries. We don't think they should. We actually prefer gilts over Treasuries at this minute. But if you speak about the front end, if you speak about the Bank of England, we do think the Bank of England's cutting in June.
Okay.
Why have we got this year wrong? And can we get this year wrong again? We keep getting the narrative shifts wrong, and everybody is, the entire market is, and it's really been difficult to judge what's happening here. You've got a gap between the data starting to turn, the language changing, and that first cut potentially in September from the Fed. Are we certain that we're not going to get any more upsets? Are we certain that the data is not going to bounce around anymore? The market keeps getting whipsawed.
You know, usually inflation is the variable that has much greater variance than growth does, right? But I think in this case, actually, I have reasonable confidence, as it seems does the Fed, that inflation will slowly come down, that we're not stalling at a high 3 number, that we are actually going to slowly come between 2 and 2.5%. But there's much greater uncertainty is growth. Right? How long will growth remain as high as it has been? And when we speak about growth, this is not Chinese growth or European growth, which actually have come in for the whole street. I don't think the street's got that wrong. I think that they have got correctly. It's the US that's been exceptional for completely different reasons at different times. In 2023, I think the main reason was really fiscal. I think the market underestimated how much fiscal stimulus there still was in the economy. This year, I think what the market is getting wrong again and again is just how much of a positive labor supply shock you have seen because of the immigration. The kind of numbers that you're seeing from the CBO is 3 to 3.5 million people coming in. And so that has led to perhaps slightly higher inflation, but much stronger growth. As these numbers change, I fear this is going to be a little weaker inflation, but much weaker growth. So I think
so how quickly does that happen? So the rate of change here is going to matter.
Absolutely right. And I think starting the second quarter of this year, so pretty much now, and you say retail sales this week, I think you're going to begin to see signs of a weaker US consumer. I think Q3, Q4 were way too strong.
Starting Q2, the labour market, so everything starts to roll over?
The labour market, I think, will roll over a little more slowly because you have two parts of the labour market, which is healthcare and government employment, which are going to hold up. So I think you'll still get numbers close to 150 to 200, but wages are coming off. So that part of the labour market is cooling off.
So the labour market starts to roll over. How does that tie into your view around US equities then, and how to position within US stocks on a weaker US consumer?
So I think the upside is going to be quite limited, right? Because out here you see a weaker U.S. consumer, inflation coming off, but the revenues for companies coming off at a faster pace. So I think the upside in equities is much more limited. At this time, I think the market is more invested in equities relative to bonds. Our view over the next 12 months would be the opposite. We'd prefer bonds over equities, much as I can see that the long end is not going to move that aggressively. But if you position in the front end, I think there's significant gains to be made, more than equities, and especially on a risk-adjusted basis. Bond vol likely to come down, equity vol likely to go up. So on a risk-adjusted basis and a vol-adjusted basis, that makes even more sense. But even if I think in total return terms, not in Sharpe ratio terms, even then, bonds over equities over the next.
The case of bonds over equities, 2 cuts expected from the Fed this year, 5 potentially next year. Bhanu Baweja, thank you very much indeed. Of course, Chief Strategist at UBS Investment Bank. And a reminder, French President Emmanuel Macron will also be speaking us exclusively to Bloomberg, of course, from the Choose France Summit. That interview with John Micklethwaite, Bloomberg's editor-in-chief. And that's at 6 p.m. UK time. Coming up, more on that summit in Paris and Macron's plans to attract more foreign investment into the country and Lizzy Burden's scepticism. That is next. This is Bloomberg.
Monday the 13th of May. Good morning. Welcome back. You're watching Markets Today. In terms of the session that lies in front of us, we've got some great interviews lined up, let me assure you of that. But in terms of trading today, I suspect it's going to be fairly limited. The reason for that is we're building up to some big data over the next few days. Yes, today you're going to get the New York Fed inflation expectations survey. But what we're really looking forward to is kind of Tuesday, Wednesday, Thursday, when you've got the real inflation prints, PPI, CPI, and you've also got retail sales coming up later on in the week as well. So that's why the market's largely going to be on hold. But while it's on hold, what Bloomberg Television has done is basically line up a series of fantastic interviews to keep you updated and informed. The French President, Emmanuel Macron, is hosting 180 CEOs and executives at the Château de Versailles for the Choose France Summit. As Lizzy's already pointed out, this is the 7th year that we are having this event. It's part of basically France's push to turn Paris into, or increase Paris's footprint as the European financial hub post-Brexit. We've got that, we've got Yellen, we've got all kinds of interviews coming up. But the French story, I think, is really interesting. In some ways, this has been successful, this event, over the last 7 years. I hear your scepticism about what is happening on the Labour front, Lizzy, but nevertheless, Paris looks like the winner.
I'm merely saying that there's more for Macron to squeeze out of these CEOs at this summit this year. You know, as I say, the likes of Elon Musk haven't put their money in yet, but this summit's already been successful before it's kicked off. You've got Amazon and Pfizer and Morgan Stanley, just some of the companies expected to boost their presence in France before it. Yeah,
the annual shakedown, then, of these executives. Yeah, I mean, well, Musk has his own issues with Labour and unions in Sweden. He's seeing that. So,
and Germany. So he's facing expansion issues in the German plants as well.
That's really interesting, isn't it, in terms of the expansion of the plant there and kind of eco-protesters. No doubt he's going to be ranting about those on X at some point. So the challenges there, and obviously the French heavily unionised labour force as well, is maybe a factor that Musk is considering. But the money has been, the investment has been there, and of course I'm sure Macron would admit and concede that there's more he can do on that front.
He needs to sort out the labour issue, maybe in France, to get more money out of the banks, maybe for Paris. Alan Katz is our Paris bureau chief. He joins us now in advance of this event. Alan, what is a win here for Emmanuel Macron? What does he need to see coming out of this event to make it a success?
Well, he's already made it a success so far this year, at least in total figures. So the Élysée said that there was more than $15 billion in investments that are going to be announced by the end of today. Most of them were actually announced either late last night or early this morning. Among the ones were the ones that you already mentioned, as well as Microsoft, which this morning said it was putting in 4 billion euros into France. And the biggest, I would say, single sector really is tech. So between Microsoft and Amazon, there's a lot of investment that's coming into France, particularly for computing power for AI. And that's a big deal for France because obviously France wants to be able to compete on the AI front. It has its own sort of homegrown champion called Mistral, which it's hoping will be able to compete against OpenAI. And so the kind of investment in the computing power needed for AI is an important win for Macron.
And Alan, I noted that France topped major European economies for FDI in 2022. Not sure about the latest numbers, but I wonder whether that's actually going up, the total FDI in France.
So it's a good question because it did top the league table for 2023 as well, at least in terms of number of investments. But that number, that total amount, is not going up. And so that's one of the problems that Emmanuel Macron faces. She's done a very good job of putting France sort of back on the map in terms of, if you're an international CEO, where might you consider investing your money? Before Macron, it was very difficult to think of France, and he really has brought it back into a country that you would consider as a place to put your investment. That said, and so it went up relatively sharply, particularly early on in his administration. Now it's really stabilized or decreased ever so slightly in France, and in fact overall for Europe as well. And so they really have this issue of, okay, they've gotten it up to a certain level, but can they get it to sort of another step higher in terms of overall foreign investment? That's not really clear yet.
How important is this broadly for France, Alan? I mean, how much of this is concentrated in the French capital? How much of this is diversified across France? And where is the European competition coming from in terms of that FDI flow?
So Choose France itself as an event has been important for France. I had a conversation with the head of the American Chamber of Commerce not too long ago, and she said to me that it really had made a difference in terms of getting American, in particular CEOs, because there's the American Chamber of Commerce, to come to France and to think about Paris in a different way, or think about France in a different way. And so it has made a difference. The investments, when there are things about, like finance, obviously, is focused on Paris. Morgan Stanley announced an expansion in France yesterday, or I think this morning, and so that's all Paris. A lot of the industrial investment is in other parts of France. In terms of the European competition, the other two main countries for competition are Germany within the EU and the UK outside of the EU. And one of the things that was interesting was that in 2023, for the first time in quite some time, the amount of foreign investment in the UK went up and pushed the UK into sort of second spot on the European league table. Again, France remains number one, but the UK is now number 2 and Germany number 3. And overall, foreign investment in Europe is not rising. It's down actually 14% since 2017 when it hit a peak. So it's sort of stabilized. Now, so there's some movement within European countries. As I said, the UK actually went up last year, but it's not, overall, it's not a wholly positive picture for Europe.
OK, Bloomberg's Paris Bureau Chief Alan Katz, thank you very much indeed on the Choose France event that continues to unfold, of course, in the French capital. And a reminder, Goldman Sachs' CEO David Solomon will join us for an exclusive interview as he takes part in that summit, that conversation starting at 3:30 p.m. UK time. Now, the Russian President Vladimir Putin has replaced his long-serving defence minister with his former economy aide. The surprise cabinet reshuffle signals a focus on growing the Russian war economy, more than 2 years after the invasion of Ukraine. For more on this, let's bring in Bloomberg's managing editor for economy and government, Silva Westall. Silva, what is the takeaway then from this surprise change at the top in terms of the defence ministry in Russia and what it signals about Putin's intentions?
Sure. I mean, I think in some ways it likely signals Putin's displeasure at some of the elements of how the war has been progressing. If you remember, if you cast your mind back to when Russia invaded Ukraine, Russia very much gave the impression that it would be a very quick operation and that it could happen without too much damage to Russia and its economy and in terms of casualties. But now we are kind of entering this period. The war has been grinding on. It's true that for the moment Russia is showing more momentum on the battlefield. But, you know, there have been long disputes within Russia about how the war's been fought, who is to blame, who is in charge, and so on. So it's fair to say that the gentle demotion of Shoigu was something that was expected at some point. I think the extent of the reshuffle and some of the picks have been quite interesting at this point in time. And it comes just days after Putin obviously won this new term as president in largely uncontested elections. So it's a reshuffle that's coming at this time.
Sylvia, clearly there's a big focus on the economy here. You could argue that he's trying to put it on a long-term war footing by making this change. Can I also connect the dots between this and what is going to be happening later on this week with Putin's visit to China, and maybe speaks to the idea that there's also a sort of economic need to tie these two countries closer together from Putin's point of view?
Sure. So if you look at the idea of naming a career economist to this role, it's quite interesting. Obviously, you know, the defence minister should be sort of looking at the battlefield, but in this sense, there's perhaps the idea that there's a need to kind of rationalise spending, looking at the ways in which the war economy can keep functioning in order to have more kind of bang on the front line, in order to kind of keep the front line going to enable Russia to advance on the battlefield. And you're right in that, you know, this relationship between Putin and Xi Jinping has been extremely important. It's very much become a relationship in which, you know, Russia needs China more than the other way around in many ways, and in some ways quite an uncomfortable relationship between the two in terms of their long-term strategic goals. So, you know, the expectation is that Putin will go there to ask for more trade with China, you know, growing ties, because China's been this real economic lifeline for Russia since the invasion of Ukraine.
OK, Bloomberg's managing editor for economy and government, Silvia Westall. We thank you for that update on the reshuffle in Putin's cabinet. It's interesting, Guy and Tom, that this should happen on the day that Rishi Sunak's making a speech where he's going to try and reframe the election that we're expecting later this year in the UK and actually make it about national security. Easier if you're the incumbent of the government. But, of course, he's trying to close this poll gap with Labour. Some polls saying that it's 30 points at the moment. And it's ironic because Keir Starmer, the opposition Labour leader, was the first to pledge that he would spend 2.5% of GDP on defence. He didn't give a timeline. Sunak swept in, tried to claim this, and now he's trying to take it even further.
The Conservatives have become very good at taking Labour policy.
Stealing clothes. Yes,
would certainly seem to be the strategy. Given the poll gap, it's going to be interesting to see how quickly he can close it. He suggests that maybe we are heading for a hung parliament. Polls don't point to that at all at the moment. Anyway, let's talk more about politics. We'll do that later on the day. We've got some great interviews coming up for you. We're going to be hearing exclusively from the French President, Emmanuel Macron, Goldman Sachs' CEO, David Solomon as well. We'll be sitting down with John Ferrer a little bit later on today. We're also going to be having a conversation with Janet Yellen. She, of course, is the US Treasury Secretary. Looking forward to all of those conversations. It's a big day as we wait for the CPI print to drop later on this week. A big week for markets when it comes to that inflation narrative. Up next, we're going to look at how stocks are positioned into this Monday. We'll be looking at the wind sector as well. Did you hear what Donald Trump had to say about winding down that sector? He did that in New Jersey Saturday. Are we going to see a reaction Monday in European stocks? We'll find out next. This is Bloomberg. 15 minutes to go until the start of equity trading here in Europe. This is what the picture looks like in terms of the expectation for the session. It's going to be quiet, though, at the get-go of the week, but it's going to build up as the week progresses. We are waiting for that inflation print Wednesday out of the United States. That is the main event. But actually, there's plenty of other inflation data we need to be watching out for as well. You've got PPI coming through. You've got the Fed survey today. I would also throw into the mix the NFIB survey as well. That's going to be fascinating to see what's happening at the lower end, the smaller end, I should say, of the US economy. Overnight, we've had plenty of news that we need to digest as well. Paul Dobson, our executive editor for Asian markets, joins us now to discuss all of this. Let's start off with China. China's going long.
Absolutely. Selling a large amount of special bonds, and the start of that is kicking in on Friday. That's what we learned today, coming in with some 30 years, and then we'll see 20 years and even 50-year bonds sold through the course of the next 6 or so months. It's important for a number of reasons, not least it's designed to inject plenty more cash into the economy to get it going again. And we saw from the weekend data how badly needed that is, with PPI continuing to remain in depressed territory, signaling kind of demand across the economy is still pretty weak as well. And we've seen a decline in overall credit, so this should rectify some of that as well. So hopefully, or the hope at least of the policymakers is that this provides a prop longer term for Chinese economy overall, and that's been reflected in a little bit of a recovery in the equities market from a pretty depressed start to the week's trading today.
Talking of duration, Japanese 30-year north of 2%. That's the highest since 2011. We're seeing that yield story developing in Japan. How much could this, although, be upset by that critical piece of CPI data that we're going to be getting out of the States Wednesday?
Yeah, so it's all about bonds today, isn't it, Guy? Wherever you look, there's an interesting narrative. Yeah. Japan hitting some impressive size and scopes there with the BOJ just easing off a little bit. But as you say, it's really all about that CPI data and whether we'll see another upside surprise in the US. That has been really the bugbear for treasuries markets and global bond markets this year. You know, we've seen some of the biggest increases in yields on CPI days. I think half of all of the increases came on CPI days. The Markets Live Pulse survey that we did last week identified a surprise increase in inflation as being the biggest tail risk for markets as well. So people will be watching that very carefully to gauge where we go from here on yields and on the Fed outlook, and that will matter for all asset classes.
OK, Paul Dobson, executive editor for Asia Markets, breaking down some of the moves that come through from the BOJ, reducing their bond purchases. Paul's staying with us. I will correct that right now, because Paul's going to give us more insights over the next couple of minutes. Really interesting on the China data front, I thought, because Paul was unpacking the fact that there was this big news around over the weekend in terms of the latest data, in terms of aggregate financing and M1 money supply. There's an argument to be made, and some of the analysts have pointed this out in terms of those watching China, that actually it's less about the liquidity that's in the system. There's plenty of it. It's the demand. And quite simply, businesses, homeowners and individuals are still lacking the confidence to tap into that credit, even as rates come down and credit becomes more abundant, because that confidence has been so badly battered. And so until you see that turn around, you can pump more liquidity into the system, but there isn't yet that demand for it.
It'll be interesting to see whether or not, as the economy starts to gain a little bit of traction, as the animal spirits maybe begin to return, that begins to switch over. Tom, sorry, Paul, let's come back to you on that. So what do we make of the credit data? Because in some ways, the picture at the moment feels very contradictory. You have an economy that feels like it's beginning to gain a little bit of traction. But if I want to know what's happening in an economy, the credit impulse is the best indicator as to what the kind of the future is ultimately going to hold.
Yes, and what Tom said rings true to me as well. Is that pushing on a piece of string kind of analogy, isn't it? You can make more liquidity available, but will people take it? Where we are seeing healthy demand for funding is from the sectors that are already favoured. In China, the renewable energy sector, for example, and tech, which we know are getting that funding boost from the government. But what everybody wants to see, who's looking for signs of a greater recovery, is more of that coming through in the consumer sector. You know, we're still seeing deflation. We're still seeing very strong competition in electric vehicles, for example, in consumer goods as well. We need to see some sort of strength in demand there to stabilise things and start to turn that around. And likewise, of course, it always comes back to the property sector. We did see quite a lot of green shoots, hopes in the property sector last week in terms of opening up home purchases to more buyers potentially, and other efforts to kind of get things going again there and get a little bit more traction. But that's really the confidence maker or breaker still in China at the moment. Putting a line under that property crisis would be the big thing that could turn everything else around.
I just want to draw a line, connect the dots between that US CPI print, but also EM debt, because you've got this kind of split in opinion. At the start of the year, it was hailed as this once-in-a-generation opportunity. Guy, you've been complaining about how the narrative has always been changing in macro terms through the year, and everyone's so confused. We seem to be at this turning point now, right? But then where does it leave EM debt? You've got EM central banks forced to slow their own easing because they're kind of following the Fed's tune. Do you argue that better yields are up for grabs here? Where does it leave them, Paul?
Yeah, well, that's a good question, Lizzy. I think the people that said that this is the opportunity of a decade think this is an even better opportunity for you right now, because we have seen that uplift in yields alongside those in Treasury rates earlier in the year. So as long as you think that the central banks will at some point be able to have that scope to start cutting, and particularly led by the Fed, which would weaken the dollar as well, then that should, all things being equal, play into that dynamic for emerging market bonds. You're right, though. We saw, Brazil recently slowing the pace of its cuts. We've heard from various central banks across Asia saying that they're going to hold off longer before they start cutting interest rates because they don't want their currency to get too out of whack. They don't want the yield difference with the US to become too vast. And we know, because when we look at what's been happening with the yen and Japan, that if you do have that huge yield gap, then it's very tempting for people to put on those carry trades and to continue to weaken your currency. And that's what a lot of them want to avoid. So some point, timing is important. Some point it's going to look like a really good trade. But the question is when and how close are we to the Fed being able to start easing? And of course, that boils back down to the CPI question.
OK, EM debt, real estate, plenty of other watchers of that US CPI print when it comes out later this week. Paul Dobson, our executive editor for Asia Markets, we thank you. Now, we're looking at European futures pointing to a higher opening this morning. Let's break down which stocks we should be watching at the open. Joe Easton joins us from our equities team. Joe.
Morning, Lizzie. So we are keeping an eye on renewable stocks today after the presidential potential nominee Donald Trump rallied against the wind energy sector over the weekend. He said that potentially some projects could be halted if he does get the White House. Now, he said that the sector is harmful against birds and whales, but it's probably most likely due to his preference for the traditional energy sector. But this is important for companies like Vestas. We can see on the screen here they get 50% of their revenue from the US, so that could be a negative. And a lot of these stocks are already having a bit of a downturn year to date, given some of the issues around supply chains and also their demand as well. But as we can see, that is one of the biggest markets for Vestas. And there's the year-to-date share moves. We can see Vestas, one of the big underperformers, Siemens Energy doing pretty well on the comparison. Then we're also going to look at the best sector in Europe, the football sector, because we've got a very rare thing. We've got a note out on the football stocks. This is from Berenberg, talking about how the Champions League is becoming even more important for this sector. Now, Champions League revenue will rise 22% next year to 2.5 billion euros. This is because they're changing the structure, making it into a more league format rather than the groups. Now, Berenberg noting that Dortmund is the one that has a strong transfer record and also has, of course, reached the final of this competition, so is getting that boost. Ajax, meanwhile, has been underperforming, so that gets a downgrade to hold over at Berenberg. And they like Juventus, but note that it is very deficit and unprofitable as well, but these ones could be in focus. There's the Ajax share move and that cut to hold there. We can see that stock has slumped since it reached the semi-final of the Champions League back in 2019. They lost to a very small club called Tottenham Hotspur, and since then the stock has been slumping, and the analysts at Berenberg think it's time to downgrade that one there. Then we're looking at Anglo-American. This one gets a big price target upgrade over at RBC. They say that even if the deal with BHP doesn't go through, there is a lot of value in the copper market. That should continue to increase given the electric vehicle exposure, according to them. But we can see that big rally since BHP announced the bid, and they have until May 22nd to announce a firm offer. So that's only around a week away. Keep an eye on Anglo, could get a boost this morning.
I can't believe you didn't talk about the Arsenal-Manchester United game over the weekend, 1-0.
I thought when Joe said a rare thing in football, he was referencing Chelsea's rare win.
Who's talking about Chelsea? Nobody's talking about Chelsea.
I'm all focused on Arsenal victory. Don't get me wrong.
Okay.
But Joe's club, Chelsea.
Got two more clubs, two more games to go for Man City, though. Are they going to do it? At least they're still in it. Arsenal, you never know. Wait and watch next weekend. Big weekend coming up. Anyway, the Open's next. This is Bloomberg. Monday the 13th of May. Good morning, folks. We are about to see the start of equity trading here in Europe. There are a few single stocks that we need to be paying attention to. There's a few sectors that you're going to want to watch out for. Keep an eye on the wind sector, given what Donald Trump had to say over the weekend. Look at stocks like Vestas, maybe. I think you're probably going to see potentially some movement around the commodity stocks with Anglo as well. But today is the warm-up act. Today is the day when we're going to kind of sit back, listen to the fantastic interviews that Bloomberg has lined up for us, and wait for the big data to drop a little bit later on. And
that big data, of course, being US inflation, the CPI print with that core component expected to come in marginally. But again, to what extent is there going to be volatility around that cross-asset, and to what extent could it reset the narrative and maybe get us back onto a disinflationary path, Lizzie?
Yeah, towards the end of the week, we're also going to get the European data on inflation. Yep. This is the final reading. Interesting to get that granularity, because that, of course, is what the ECB is looking for when it's considering that June cut. Almost a certainty in markets at this point.
It's interesting. We do sort of build up to, we've got the New York Fed's out with its inflation expectations data today. Now, that in some ways mirrors what we get as a result of the data that we get from the University of Michigan in some ways. And what we saw in that data was a pickup in inflation expectations and a drop in confidence. Now, that's kind of, that kind of one feels like it goes with the other. The consumer is really worried about inflation right now and maybe is actually drawing down spending as a result of that. And I wonder whether that's going to show up in the retail sales data as well this week, which I'm interested to see which piece of data this week the market reacts most to.
Yeah, and the question, as I say, being at what point did the savings run out?
Yeah. And does that start to show up in the spending numbers? The employment story was last week. This week it's about spending and inflation. Those two, in some ways, going to be impacting each other quite significantly. Right, here we go. European markets expected to open. I don't mean to downplay today's session because it is going to be exciting and there are going to be some single stocks that we're going to be watching out for. But nevertheless, the real story kind of progresses. So, as I say, we've lined up some really big interviews for you over the next 24 hours. So, in terms of the early indications, and I'm dealing just with points here right now, Novo Nordisk out of the gate quite strongly. ASML is up as well. There's a fantastic piece on the Bloomberg terminal talking about the chip investment that we're seeing globally at the moment. ASML is a big picture, the big piece of that. And here we go. I'm waiting to see, at the moment, I'm seeing Vestas up. I just want to double check that, but it looks like Vestas is going to be a big gainer this morning, despite what we heard from Donald Trump. So maybe actually that early read that Donald Trump, were he to become president, would be negative for the wind sector, doesn't seem to be holding up. Because at the moment, I've got Vestas up by 3.3%.
Yeah, 3.4% right now on Vestas. They have, of course, above and beyond the Trump story, have struggled in terms of input prices and in terms of ensuring that there is that demand across wind energy. Some of those companies started to see a bit of an improvement. But yes, in the session today, Vestas, one of your big gainers so far. We watch as well the mining space, given that copper and iron ore has had a bit of a lift. You maybe tie that to expectations that could be more fiscal stimulus coming through from China, with, of course, those ultra-long bonds, 20, 30 and 50-year. But the basic resources sector is actually currently down around 0.3%.
I'm fascinated. It's quite a decent... This is a big gap higher for Vestas first thing this morning, and this stock has been climbing... the stock is up by nearly 10% over the last 5 days, so that captures some of the earnings numbers as well that we saw last week. But a really quite chunky gap higher first thing this morning that's beginning to unwind a little bit, but clearly the market's not listening to Donald Trump.
In terms of sectors on the move at the open, travel and leisure, the biggest gainer, up 0.5%. Tech just behind it, up 0.3%. Bottom of the basket, though, as you say, Tom, basic resources this morning. It's the CAC 40 that's in the red, as well as the FTSE 100. The CAC down 0.1%. Interesting backdrop for Emmanuel Macron's summit later. Choose France, he'll have to tell them.
Yes, well, of course, we're going to be hearing from the likes of Goldman Sachs' CEO, of course, David Solomon, is going to be speaking to us around 30 p.m. UK time. Here in the UK, the FTSE 100 currently at 8,427. So the FTSE 100 down about 0.1%. European stocks, of course, for the context, notching record highs on Friday as well. Over in Germany, the DAX is off 0.1%. Right now, guys, obsessed with the wind story. Are we just brushing off the fact that Trump has suddenly decided that he really cares about whales and birds? I don't know.
That was a little mystifying.
Incongruous, wasn't it?
I've also just been reminded that the Danish market was closed at the back end of last week, so maybe this could be some catch-up trade as well. So maybe that's the factor, that we're just playing catch-up a little bit in terms of what the other markets have been doing, and it's less maybe to do with what we're seeing from Donald Trump. The main story, though, continues to be what is happening with the narrative around the macro this week. The earnings story is beginning to wind down a little bit. We're still waiting for Nvidia and some other big stocks that are still going to be reporting numbers. But it's all about the sequencing around the central banks, who's going to go first and how big they're going to go. This is what Baweja of UBS had to say a little bit earlier on in terms of how the market is positioned for that narrative.
I don't think the ECB is that mispriced at all. I think the ECB is being priced fairly correctly by the markets. If anything, I mean, there's a small possibility that the ECB doesn't move as quickly as what the markets are anticipating, and that's because wages are going to move much more slowly in this region. So growth is weaker in this region, but wages will come lower slowly because they're much more sticky. The labour markets in Europe are much more slow. There's greater inertia here. But I think the Fed is way more mispriced than the ECB.
Baweja, Chief Strategist at UBS Investment Bank, speaking to us a few minutes ago here on set. Let's carry on the conversation now. Joining us now, Ed Cole, Head of Multi-Strategy Equities at Man Group. Good morning.
Morning.
Let's kind of fold in the central bank story into the equity story. We've come through the earnings season, largely seems to have been sort of, on both sides of the Atlantic, a fairly decent one, certainly relative to expectations. But we're now trying to figure out if Europe continues with the momentum that it's seen recently, European equities. Is that down to continuation of earnings? Is that down to the ECB cutting rates? What is going to be the next catalyst, the next driver for European equities, and do they continue to outperform?
I mean, it's always earnings, and I think ultimately earnings is what drives equities in the medium term. Beating in a season is not a big thing. Yep. Companies guide down, right? So I think we should all be used to beats. For me, look, I think the outperformance of European equities is probably predicated on two things year to date. One is how spectacularly bearish everyone's been on Europe for so long, and I put UK in the same perspective. The kind of near certainty in Q4 last year that Europe was done. You know, there's such sort of structural problems in European economies that outperformance was almost impossible. So that's kind of a consensus to kill. And then, of course, there's currencies. I think as we've started to see divergence in central bank policy expectations and the dollar has clearly remained stronger and we've had some weakness in euro and sterling, that's been pretty helpful to equity markets in these regions. So does that continue? In my mind, yes. Bhanu put it well. I think that in all likelihood, you know, at the moment we're kind of reasonably clear that Europe looks more sluggish economically. So the path towards European cuts looks reasonably secure. And then there's a question about the extent to which the Fed will cut. To my mind, that's something that we probably will see at some point this year.
Okay. But I think unpack that all for me. So where does that leave me in terms of this catch-up trade that Europe has had. It has been sluggish. Expectations got too bleak.
Yeah.
We're starting to close that gap. How much have we closed that gap? And if we do see central bank ECB cuts coming through and the Bank of England, does that move accelerate? Does the closing of the gap continue to accelerate?
Well, the long-term gap, no. I mean, like the long-term gap here is that the US is the most innovative economy in the world, stuffed full of the best companies in the world that trade at a much higher multiple. Are we going to close that in Europe? No, we're not. Tactically, European equities have outperformed US year to date in a risk-on move. I think as long as risk appetite remains intact, that probably continues. My concerns are twofold. I guess near-term, I have a particular concern near-term, and then I have a bit of a concern. And then I have a concern a bit later this year. The near-term concern is that we had a volatility shock that went through the market in April, which started actually, I can't prove this, but I don't think it started with the geopolitical concerns. It started on about April the 8th when two-year treasuries blew out of their range. And to my mind, that put a load of volatility through cross-asset structure. And we saw a kind of breakdown in cross-asset volatility, which peaked just around the week after the geopolitical tension in the Middle East. That was clearly part of it. Typically, and we've had a very sharp bounce in risk appetite since then, but typically what happens is when you look at those moments when risk appetite breaks to the extent that it did, and there are various ways of measuring that, but sort of standardized measures of cross-asset volatility, when they break to the extent that they did in the middle of April, they very rarely form a V-shape back upwards. Typically what happens is you have a bottoming process where things, in fact, typically when we've gone back and looked at those data, they make lower lows. Now, that's just a sort of empirical observation, but to my mind, we're sitting here today with this big bounce in risk appetite off a pretty kind of difficult April environment. Lots of headwinds out there about what happens in policy in the near term. Volatility is incredibly low again, right? I mean, the VIX has collapsed, which perhaps suggests some complacency. And I think tactically, we need to be a little bit concerned about the fact that all of that vol and the de-gearing that started in April may not be done.
So how do you position? You still see, broadly, top line, you still see further momentum for European stocks. How do you position to capitalise on that whilst also hedging against that potential complacency you're seeing when it comes to volatility?
Luckily, we're a hedge fund, so that's our job. I think it really comes down to sort of thinking medium term about what's mispriced, where there are asymmetric opportunities. I mean, when we talk about inflation, we have to think about it on a global perspective, I think. I think it's pretty clear that despite the stickiness we've seen, if we think about the US, which is, even if Europe is prepared to move earlier, which we saw a bit of that last week, ultimately we're all waiting to understand what happens with US inflation and what happens with the Fed. And the good news there, to my mind, is that the data we've seen out recently on the labour market is starting to suggest that things are loosening, that all of that tightness in the labour market is now easing. Critically, that's happening in wages, with average hourly earnings slowing. And just to put some numbers on that, you've gone from about 5% quarterly average hourly earning growth from second half of 2022 through to the end of 2023, about 5% year on year, down to about 3.5% year on year, year to date. That's a big step down, right? And that's showing us that the slowdown in job openings, that all of that tightness is now coming out of the labour market. So if we get beyond this tactical concern that I have, which empirically suggests we need to be a little bit worried right now, I think we're probably in an environment where what we've seen in the last few weeks, bad news is good news. So slowing labour market data, slowing economic data will be perceived to be good because it gives the Fed that room to kind of stay on the path it's been indicating since November. And that's probably a reasonable environment for equities. To your question about how do you play it, what looks interesting. For me, it's interesting. I was sitting there waiting to come on, and I was remembering that when I first came on here with Danny and Manus in November last year, my recommended trade was kind of rate-sensitive equities and some of the sort of better quality commercial real estate stocks. And I'm a stop clock. It hasn't changed. I think that if we have now a bit of a more confidence in a slowdown in inflation and a bit more of a bid for bond duration, that bond proxies are a really good place to be in the equity market. you have to be really specific about the types of companies you're buying. That, you know, these sort of heavily leveraged businesses with bad balance sheets are not going to get bailed out. But if you can buy, you know, good real estate companies in sensible places in the logistics supply chain, for example, that are on low LTVs with, you know, with good growth in demand for what they do, then that looks like a good place. And I think you have a tailwind from bonds.
So it feels like so many of the assumptions from the start of the year have been smashed to pieces, punished by the markets. What's the biggest thing that we're getting wrong at the moment?
Well, I mean, I've been guilty of all of them, so probably what I've just said. And actually, I kind of mean that in a way, because I think one of the things that I've spotted, you know, sort of reading, trying to pick up consensuses is important at the moment, because everything I think that seemed so obvious over the last 2 years has one by one, these things have been dismantled, right? These certainties have been picked apart. And, you know, at the beginning of the year, I mentioned the certainty that Europe would underperform, and there was a certainty that China was broken. And I think that the new certainty that I've picked up, and I've been guilty of myself, is this kind of blanket assumption that US nominal GDP is growing at 5 to 6%. You just read it everywhere. Everyone says, well, US nominal GDP is growing at 5 to 6%, so 10-year bond yield should be at 5 to 6%. And I've been guilty of that myself, as I say, but I think that might be the new consensus. I think that might be the thing that over time we're going to start to see the CPI data moderating. That's going to be tested this week, of course.
Yep.
And that's the thing I'd be looking out for now, is that a bid for duration could be the surprise. One more thing, if I've got the time, is... Very briefly, is that possible with that slowdown, that as we get to the second half of this year and towards the end of this year, we're going to start talking about that landing again that we are not talking about now. Yeah,
we certainly feel like we're in a no-landing environment at the moment. Ed, thanks for the honesty. Always appreciate it. Thank you very much indeed. Ed Cole, Head of Multi-Strategy Equities over at Man Group. Let's talk about some of those equities. A little bit of a catch-up trade maybe coming through in some of the Danish stocks this morning. But as you can see, we've got a bid into Novo Nordisk. It has been closed, that market, over the last few days. Elsewhere feels a little bit more quiet. Ferrari kind of maybe mulling those numbers over the last few days. A little bit back into chips. But LVMH, the luxury sector, looks like it's having a little bit of a better day. Let's dig into the details a bit more about what's happening this Monday with Joe Easton.
So we're going to start with AP Monomers. We've got a massive jump. It's the biggest gain this year. It was the biggest gain in 4 years for that stock when it was up about 10% at the open. As you've been mentioning, it is a bit of a catch-up trade. The Danish market was closed on Thursday and Friday, so all of those stocks seeing some movement. But during that time, we've also seen a rise in some key shipping rates, including in Shanghai, according to analysts over at Stifel. And there's another note out from Citi I was reading today, pointing to a potential $800 million gain in profit at Maersk, given the rising rates due to the Red Sea issues that we've seen. So those are all the factors at play for that one. Then in terms of those wind stocks you mentioned in the open there, but we did see a bit of movement. Where's Vestas? Vestas pretty much unchanged at the moment, but Ørsted coming down, Siemens Energy as well. Donald Trump, he's very concerned about whales and birds, isn't he? But also giving that warning about the potential projects, and would he issue an executive order if he gets the nomination, and then the White House, could he come down hard on that sector? Then we're looking at football. We mentioned in stocks to watch, we got this note out from Berenberg talking about the Champions League positivity and the more importance of that as the league gets bigger next season. Ajax is downgraded, but that one pretty much unchanged at the moment. Juventus ticking higher. They do like Juventus, but are worried about the debt there. BVB is the one they really like, Borussia Dortmund, in the Champions League final. However, that one has risen a lot. We've got big games this week in the Premier League. Tom Mackenzie will be wearing a Tottenham Hotspur shirt for the first time ever, given the game against Man City tomorrow. But we'll move over and look at earnings, because there are some big movers in this sector, even though we are looking at the more mid-cap, smaller companies at the moment. Diploma here in the UK and Prysmian, these are both in the electronic cables and components business. Prysmian is more in the energy sector, Diploma in construction. This one in the UK, that was up around 11% at the open. It's coming down to 5% now, following their reports. Economy, this is your white goods, your dishwashers and fridges in Germany, doing pretty good numbers out of them. And K&S over in chemicals, that one is pretty much unchanged after their reports earlier today. One big mover to show you in the deal space. It's a massive jump. It's OX2. Now, this is also in wind. It's renewable energy. So sticking on that theme, we've been looking at them. Look at that one. It's up 42%. They got a takeover bid from EQT, the publicly traded private equity firm. That one actually ticking very slightly higher, but 42%. We're not going to beat that today, are we? Finally, on a morning call, BAE Systems. This is an interesting one. It is, of course, a defence supplier. Finally, a downgrade. Most people love these defence stocks, but that one is cut at Bank of America. It's all due to valuation. It's doubled over the past couple of years. It's a massive mover, and that one is declining today as Bank of America books profits on BAE Systems in London.
OK, down a little over 2% on the back of that downgrade. Joe Easton running through some of the stocks on the move for us and highlighting, of course, the gainer, the top gainer across these European markets, AP Møller Maersk, of course, the shipping company, up just shy of 9%. Bottom of the list, Holcim, one of Anna Edwards' favourite stocks, cement maker. Cement maker. We do miss her. Holcim currently down a little over 3%.
If Anna's watching, just ignore Tom.
We do most of the time.
She loves a bit of cement. Infrastructure.
European cement.
Yeah.
Excellent. Concrete.
Yeah.
Excellent. The Maersk story, I think, is interesting as much as it's just a catch-up trade. So its main rivals have been rising over the last few days, but Maersk has been closed over the last couple of sessions. And as a result of which we're seeing that kind of catch-up. But it's interesting that Vestas gapped higher first thing this morning, but then has now sort of faded that move quite quickly, maybe on the back of this speech that Donald Trump gave. As you say, he's concerned about whales, he's concerned about birds.
He's long had an interest in marine life, hasn't he, and protecting those ecosystems.
Yes. I'm not sure where to go with that, but yes, I think Tom maybe had a little fun with us this morning. In terms of what else we got coming up, talking of fun, we've got some great interviews lined up. We need to be talking about the interview we've got coming up, of course, with the French president. He is going to be joining our editor-in-chief, John Micklethwaite, a little bit later on. The Goldman Sachs CEO, David Solomon, is going to be joining John Ferro as well. They're both going to be at the Choose France event, which is taking place in Versailles. But in Washington, we are also going to be speaking to the Treasury Secretary. That conversation, very much one you want to be paying attention to. Janet Yellen coming up on Bloomberg Television. What are we going to be talking about next? We're going to discuss the efforts to gain chip supremacy around the world. In some ways, this goes to this Choose France event as well, which is taking place today. But the battle for supremacy, obviously, is significant. Huge amounts of money being invested. How does China react to this as well? We'll talk about all of that next. This is Bloomberg.
Good morning. Happy Monday. This is Markets Today. 21 minutes into the trading session, you're seeing modest gains of about 0.1%, just shy of that on the European stock 600. Now, superpowers led by the US and the European Union have funneled nearly $81 billion into producing the next generation of semiconductors. It's part of an escalating, of course, global showdown with China for chip supremacy. Let's bring in Bloomberg's Gao Yuan in Singapore, one of the reporters on today's fantastic Big Take, which is really worthy of your time. Gao, who is leading the effort then to fund these chip firms?
Hey, nice to see you, Tom. Yes, of course, the U.S. is definitely in the lead because you may have remembered the Biden administration introduced the CHIPS Act in 2022, when the government introduced the $39 billion in investment in chip manufacturing sectors. And a lot of countries are actually following, including Japan, India, European Union, and of course, a big chunk of it coming from China, which is trying to develop their own technologies and make breakthroughs so that they can be dependent on their own chip technologies.
And it feels like there's a kind of ramping up of these efforts. So many countries funding domestic chip making. Why the recent interest? Is it just because we've got elections on the horizon?
I think more than that, because chips are the most critical components when you want to make all kinds of devices, from smartphones to airplanes to defense systems. So every country wants to develop their own technology know-how and probably give their own domestic technology a boost. That's essentially the biggest reason, especially when the time that everyone is on the verge of developing their own technologies, and when it comes to the companies that basically they are trying to do yes.
How big is the gap between China and how big is the gap? How big is the gap between China and the United States right now? There seems to be conflicting information. Some are suggesting the gap is enormous, that the United States has a huge lead. Others suggesting that actually the Chinese are much closer in terms of performance than we originally thought.
Yes, the gap is pretty big, actually. We are talking about the generations, because China now is only able to make what we know 7-nanometer chips, but now with the help of Taiwanese companies like TSMC, the U.S. can make 3, maybe 2. So that's the gap we're talking about. So China is pretty much lagged behind. And to answer the previous question, basically because everyone wants to control the chips so that they can have their own technologies, their own plan makers, their own smartphone makers. That's essentially why making their own chips is very important for all these countries.
Yuan, thank you very much indeed. As Tom says, a fantastic piece on what is happening with the global chips industry and the race that has accelerated post-pandemic to make sure that each individual country, each individual region has a footprint, a much bigger footprint than originally conceived. Find it on your Bloomberg terminal. Also, you can find on your Bloomberg terminal what is happening with these markets right now. Let's talk a little bit about what the sector story looks like and break down what these markets are doing this Monday morning as we await for the CPI data to drop a little bit later on. As you can see broadly, stocks, I think, are just basically hovering around the flat line. We are seeing very little movement today at a headline level. I suspect that continues throughout most of the day. We maybe see that maybe punctuated a little bit by the New York Fed data we're going to see a little later on consumer expectations around inflation. But it's when we get into PPI and CPI Tuesday, Wednesday, guys, that it's going to be important. Powell speaks tomorrow in Amsterdam. Powell is going to be in Amsterdam tomorrow.
Yeah, before the CPI print, of course. And to what extent do you want to be putting bets on the table ahead of what we hear from Jay Powell and ahead of that inflation print, to your point? So something of a holding pattern as we look at European stocks up about 0.1%. As you were saying, travel and leisure, real estate near the top, construction down 0.4%. Lizzie?
Just a reminder of some of the amazing conversations we've got on the docket coming up. The French President Emmanuel Macron is going to speak exclusively to Bloomberg from the Choose France Summit. Catch that interview with our Editor-in-Chief, John Micklethwaite, at 6 p.m. London time. Before that, we'll also have an exclusive interview with the US Treasury Secretary Janet Yellen. That conversation kicking off at 3 p.m. UK time. We'll be back with plenty more. As you say, stocks trading sideways here in Europe. This is Bloomberg. This is Markets Today. We're 30 minutes into the European trading day. Stocks kind of treading water at this point. The Stoxx 600 just higher, 0.1% at this point. Looks like they're going to keep treading water all the way until that US CPI print later in the week. But let's look at what else we've got coming up for you. Euro area finance ministers meeting in Brussels. We've got the Choose France summit today. Lots of interesting interviews coming out of there, including with the French President Emmanuel Macron. We have the final German CPI data as well. We have the Qatar Economic Forum starting in Doha. Interesting to hear about how the Middle East is going to react to that chip-making war we were just talking about there. Chinese earnings as well, coming out of Tencent and Alibaba on Wednesday. And then we get Euro area first quarter GDP. And in geopolitics, we've got the Russian President Vladimir Putin starting a 2-day visit to China. This after Xi did his own tour of Europe last week. Then on Thursday, as I say, in fact, on Wednesday, we have the US CPI print and we have earnings from Walmart and Siemens as well. The NATO military chiefs meeting in Brussels on Friday and, of course, Chinese data. We've started with some today, but we've got property prices, retail sales and industrial production all to be released. But, guys, the highlight really of the week is the CPI print. It's the first of 2 inflation readings before the next Fed meeting.
And I think you combine that with retail sales as well. Very anecdotally, when I was in the US a couple of weeks ago, I think there's a link, obviously, between what's happening with the politics and that support for Trump, who is polling above Biden now in some of the key swing states, and the sentiment amongst communities. And very anecdotally, you know, you do pick up on that frustration around higher prices. And people are still obviously going out and shopping, and you've seen that in the most recent data year to date. But when that starts to collide, and when that starts to break down, you're going to have a bit of trading lower already. So you're going to get the Walmart earnings as well and retail data. And I think that may start to tell us a slightly more negative picture about.
You saw the University of Michigan data Friday. Basically, that encapsulated it really nicely.
Yeah.
Consumer confidence has been dinged up. That number comes down really sharply. The inflation expectations component of that data shows a big pickup.
Yes.
The consumer's picking up on the inflation story. And that's why Wednesday, Thursday, that kind of positioning between US CPI and then the retail sales number the following day, I think, can be really important. And I wonder whether or not, which piece of data gives us the bigger reaction? If you get kind of the CPI comes in as expectations, but then you see retail sales rolling over aggressively, that's the US economy. The consumer is the US economy, and if there's any evidence of weakness, that's going to be a problem.
To your point, Tom, I don't know if it's all anecdotal, because there was actually a piece on the Terminal about how your political leanings are influencing your economic sentiment, and actually it looks like Republicans and Democrats are equally gloomy about the economy.
Let's bring in Emma Moriarty right now, investment manager at CG Asset Management. Emma, are we on the fringes of a stagflationary economy in the US?
I think it's a good question. You know, obviously, Jerome Powell the other week came out and said there's no stag or no inflation. But I think we are at this turning point in the US economy where, on one hand, you know, all of the inflation data, and then we had the University of Michigan data last week, showed evidence of this higher for longer, much stickier inflation than people expect. But then, on the other hand, we've also had, you know, the senior loan officer survey come out saying actually standards are tightening, demand's down. The San Francisco Fed put out a piece saying that actually households have probably used up all of their pandemic savings now, and we're starting to see potentially the beginnings of cracks in the labour market. So, you know, probably the Fed's taking the right approach here with saying, well, we need to see a set of consistent data, because at the moment we've got a lot of data points pointing in different directions, and it does seem to be starting to create volatility.
How does the market pricing look to you around the Fed right now?
Well, I think the market pricing's come in somewhat. You know, we're now sort of, while the Fed's dot plot had originally said 3 cuts for this year, pricing's moving into sort of 1 to 2 cuts. And given everything that's come out of the sort of slew of Fed speakers saying we need to see more consistent data, it looks like even if all the data do line up, there's probably only enough time left for 1 to 2 cuts this year in the absence of a major movement in the labour market.
So what am I doing? How do I invest around it? Is the market positioned correctly right now? Is it better positioned in Europe versus the United States? Is it easier to call Europe versus what is happening in the States? I'm fascinated at the moment that the volatility story seems to be in the States rather than over here. Europe seems like it's on rails for cuts at the moment.
Yeah, I think there's 2 aspects of the story. There's the rate side of the story and the currency side of the story. And so, you know, in terms of, like, do you want to be in, say, the euro or sterling versus the dollar, there are a lot of factors supporting dollar strength. And that's not just a rate story, that's also a sort of relative growth story. I think in terms of relative interest rates, the Bank of England and the ECB have been much clearer in signalling a sort of potential bias towards cutting or dovish pivot in the Bank of England's case. So, you know, there has been just much more willingness to cut communicated by those central banks than the Fed, where people have been increasing and coming out and saying, well, we'll keep monetary policy here for as long as we need to.
But in terms of our understanding, we've been buffeted by narrative shifts all year. And I'm wondering if we're done with that. In Europe, it feels like a much more clear and easier to understand narrative than over in the United States. Do the shocks continue to come from the United States versus Europe?
I mean, potentially. I think the Europe story, you know, may get a little bit more complicated. We've started in the sense that, you know, Europe had been a very clear story of tight monetary policy has been suppressing demand and inflation has been coming down. I think what we've now started to see, particularly in the German data, is something a bit like what's happening in the UK, where it's now this similar question on one level to what's going on in the US. Is everything about to reaccelerate again, particularly now that there's real wage growth? I think the US has the luxury of it's just had much stronger demand. And so the need for cut has been much less pressing.
And of course, in the UK, we did just have that little surprise on GDP on Friday. The UK now out of recession in the rearview mirror. Does that delay a June cut for you? Or what would it take to make a June cut not a fait accompli, as Andrew Bailey called it?
Yes, I mean, I think it definitely does potentially delay a June cut. I mean, if you look at the latest round of Bank of England forecasts that were put out, they were conditioned on this recession data. And obviously, while a lot of the move came in the trade balances rather than necessarily domestically driven demand, higher growth definitely does shift the dial, not just from a forecasting perspective, but also from, sitting in the central banker's seat, just giving a little more confidence that inflation is trending in the right direction.
It's interesting because not everyone would agree with you. They would say perhaps that GDP is backward-looking and there's more focus on inflation and services, wage growth instead.
Yes.
But also I want to ask you about QT and the impact on markets, because there's been a lot of concern about active bond sales putting markets on edge, and yet we didn't get an announcement. They've put it off until September. Is that responsible?
I think definitely. I mean, one of the messages that the bank and the Federal Reserve have been trying to get out is that they want bank rate or interest rates to be seen as the primary tool of monetary policy. So I think keeping the debate around sort of short-term interest rates front and centre has probably been the right thing to do to drive home that piece of messaging.
Lizzy, I think it's really interesting because I asked the question for a reason, and that is there's this idea that the US is where the volatility. We don't know what the Fed's going to do, but in some ways, you've got this message coming through from the Bank of England and from the ECB to a certain extent that is we are going to cut rates. But as you point out, you've got this data that's starting to talk of a story that is of re-acceleration. Is there a danger that actually Europe provides the surprise because inflation comes back? And actually, this rate-cutting cycle may not be as aggressive as we think.
And it's not just that. It's the fact that Christine Lagarde and Andrew Bailey now have really put emphasis on this data. It's not just that they're saying they're data-dependent. It's that these specific data points are what we need to see to do a June cut. So I think you're going to see even more volatility over the next couple of months.
Well, where that leaves us in terms of our views around bonds versus equities then, Emma, because UBS's Bhanu Baweja was on here earlier and he said, look, it's clear for us that the preference is bonds versus equities right now. Would you align with that view? Where do you sit on that debate?
I think there are sort of pockets of value in a lot of different markets. I think definitely in the UK, equities in particular are now looking incredibly attractively valued, particularly where we are in the interest rate story and with a bit of positive news on growth. Whereas if you take a look at the gilt curve, it's probably still priced a little bit richly for how many cuts we actually expect to come. But, if you look into the US markets, very short-dated treasuries are now looking quite aggressively priced, and so there might be good value to be had there.
OK, so maybe some value to be had in the short end, the front end of USTs, but gilt's looking a little rich in terms of what's expected from the BOE. What's your take on the earnings story? Obviously, we've been talking about that, but it was a pretty solid beat, of course, so far across S&P listed companies. Gains earnings are coming in about 8% above forecasts or thereabouts. Where does it leave your view on which companies kind of the best kind of match fit businesses as we lead up into the next quarter? How has that adjusted your view, and where's the tech story in that?
Yeah, I mean, I think in some ways this is very linked to the wider US economic growth story, in terms of there's been a lot of commentary for some time that US equities valuations are looking extremely stretched, and when does the music stop on this? And probably it's the same time that the consumer starts to break. So
you think we're closer to that point?
I think we must be getting closer to that point. If you look at it from the perspective of, say, like the US household balance sheets, which are now looking in much worse position than they were this time a year ago, for example, we must be getting closer to that point, and therefore probably in the US would favour sort of value names over the growth names.
OK, Emma Moriarty, thank you very much indeed. Investment manager at CG Asset management. Coming up, Softbank reporting a second straight quarter of profitability. We're going to have more on the AI investment boom that has buoyed assets, including, of course, chip designer ARM, for which Softbank has an 80% plus stake. More on that next. This is Bloomberg.
We're 45 minutes into European equity trading, and to be honest, at a headline level, nothing is happening because we are all waiting for the inflation data, which is going to be posted over the next few days in its various forms out of the United States. We get some inflation data out of Europe at the back end of the week as well. But nevertheless, we're basically waiting for this. Are you brave enough to take on a big position in front of that number? I think the headline numbers would seem to suggest that the market is going to be cautious on that. I suspect below the surface, maybe actually, given the asymmetry of the risk around this number, there may be some positions are being built. But we'll see those maybe develop over the next few days. In terms of the corporate news we have this morning, over the last half hour, we've been monitoring what's been happening with Softbank. It's starting, the breakdown is currently kind of trickling onto our screens. Tom, what are we seeing?
So, second quarter profit for Softbank. And again, the AI story is coming here through with a really big lift, particularly via ARM, for which it has a massive majority stake. And that company, of course, IPO'd in the US, to much to the chagrin of many a politician here in the UK, with a gain of about 113% over that period since it listed for ARM in terms of the shares. So, Softbank benefiting certainly from that, and their CFO has been talking about that. Of course, the Vision Fund as well. Losses from the Vision Fund, though, still pretty pronounced. Again, top lines in terms of for the quarter, Softbank net income coming in comfortably above the estimates. But let's get more of a breakdown and more analysis and bring in Alex Webb from Bloomberg Originals from what we've been seeing from Softbank, what it tells us about that AI momentum and what it tells us about some of those big bets coming through from Masayoshi Son and the team there. Alex, what kind of stands out to you from these earnings?
I mean, the increasing reliance on ARM actually is quite interesting, given that there were various junctures where they thought actually, well, particularly when Elliott was involved at Softbank, they were sort of saying, just get ARM off the balance sheet, right? Like at this stage, you're not really sure we see the advantages. That is not something that clearly they want to be doing just yet. It's still consolidated into their earnings. The net asset value, which we've also seen increase, presumably has benefited quite a lot from the bump that ARM saw. Presumably at the end of the quarter, that's when we actually saw that have an effect. It's corrected a little bit down since then, particularly as investors have realised that maybe it's not quite the AI play we thought it was. But the company is really trying to increase its exposure to AI. You have to ask, are they picking the right time in the cycle? But we'll see that in the coming months.
In terms of what happens next, so ARM in some ways is a rearview mirror story. They've got cash on the balance sheet. What is the objective now for the fund?
Well, I mean, there's the fund and then there's Softbank itself, right? Okay. And the Vision Fund is one thing. Vision Fund has not been doing brilliant. They've been selling down a lot of their stakes, as our colleagues reported, I think, just before the weekend, not least in Coupang, in DoorDash and others. If they are able to get this big AI play off the ground, which has been reported by us and some others, they're trying to get they develop their own competitor, essentially, to OpenAI, or more like a competitor to NVIDIA, my apologies. If they can do that, that'll be fascinating, because NVIDIA has been doing this for 25 years, right? Now, if that's a success, and it is the moonshot that he's long been trying to do, then that could do a lot for them. And that's when actually you start playing well with ARM, and ARM could maybe ride the coattails of that, because ARM has exposure to AI, but basically in the sense that it designs chips that support the AI chips. It's not actually the AI chips themselves. So if you can find a way of playing nicely together, then there's a real sort of synergistic effect there.
Yeah, so what sort of things are we looking at as Masayoshi Son's pet interests of the moment? We've been talking about ARM and how it had that lukewarm revenue forecast, the shares diving last week. Where are they looking next?
Well, I mean, it is that AI play, right? It's how do you get the greater exposure to it without paying through the nose, right? Because at the moment, all AI valuations are massively inflated. GraphCore looks like a very fascinating opportunity right now. That's a British company that is just making chips, designing chips at least, that are specialized towards AI, you would think that GraphCore right now would be having a really good time of things. We haven't seen evidence that that is the case. They've had a few issues, the suspicions that maybe it's harder to get the manufacturing capacity, given, of course, that NVIDIA and Apple and others are gobbling it all up at TSMC. So if they are able to somehow turn GraphCore into a success, that will be fascinating, because I think, who was the investor? Sequoia had a big stake in GraphCore. They wrote down a lot of the value of that stake. So they're probably going to be getting GraphCore at not the exorbitant price that it might have been a few years ago. That does provide an opportunity if the technology is as good as everybody would, or as GraphCore wants you to think it is.
You're being very diplomatic about the challenges that GraphCore has faced, and maybe that's going to be a fire sale. But maybe, as you say, there's real intrinsic value there that Softbank can use their massive balance sheet to extract. How much have they learned from the kind of failed bets on companies like WeWork? How much has that changed Masayoshi's thinking and the way that he allocates capital?
It certainly looks as though they're more interested in actually, technologies, right? Famously at WeWork, he said, you've got to be crazier than the other person, than the person you're competing against. And the way that the kind of vision funds seem to work was just let's put so much money in some of these companies that we outspend all the competition. That means that we end up as the only player in the space, whatever the given company is, and then at a certain point, presumably you can hike prices, and then you're in an interesting, you can generate some healthy profitability. That didn't really work, and we saw a few other things in the way that they invested, and there were questions raised about, well, actually, is this new round really generating new value, or is it just helping the book value? There has been a certain amount of humility, I think, as a consequence of that, some acknowledgements that maybe they got some things wrong there. The Vision Fund 2 didn't really go anywhere. Now, when we think about this new push into AI, they are very much going for technology that exists, and if they can get these things we mentioned off the ground, some of the core underlying pieces of it.
Can you catch up in the AI business if you're not based in London, not based in Cambridge, not based in the United States, not based on the West Coast? How difficult is this to do outside of those big kind of AI spheres that exist at the moment? How concentrated is the talent, the skill set, and the ability, therefore, to catch up, making it harder for everybody else to do? I'm just kind of wondering how this race is developing. If you look at where does Japan sit in the AI story more broadly?
Yeah, I mean, don't forget China on that list. China's got quite an event. Yeah. But yeah, I think there's probably some truth to it. I think you don't want to say Japan has no AI talent, because it clearly does.
Yeah.
We've seen some differences, though, in terms of remote work has made a lot of these things easier, right?
Yeah.
But I think it's more diffuse than in other new technology revolutions, right? There's a lot in Paris, right? So you're not just talking about London and San Francisco. You're talking about the sort of, whatever you call it, the Golden Triangle, London, Cambridge, Oxford. You've got San Francisco. You have some people like, actually, in other parts of the US. You have France. You have, of course, China. There are quite a lot of places you can play. And in SoftBank, it isn't restricted by Japan, right? It clearly plays in a lot of different markets. So I wouldn't overplay it. It is nonetheless true that there are some concentrations.
OK. Alex Webb, we thank you. The latest on those SoftBank earnings, how they're playing out in the AI world more broadly. Better than expected net income in the March quarter, a second straight quarter of profitability. We'll have plenty more coming up today. We're going to be speaking exclusively to the French President Emmanuel Macron on trade, geopolitics, international investment. And you can hear that interview with John Micklethwaite, our editor-in-chief, at 6 p.m. UK time. We're also going to speak to the Goldman Sachs CEO, David Solomon, joining us for an exclusive conversation as he takes part in that Choose France summit. That conversation at 3:30 p.m. London time. It's going to be a fascinating summit, this one. Macron really trying to sweep up the investment from the 180 bosses joining him in the Palace of Versailles.
But I do wonder whether that AI story is going to be front and centre. It's interesting, over the last few years, it's really focused on Paris as a financial hub. I wonder whether there's more to it this time in terms of the AI story.
Real AI talent that comes out of the universities of France. And you see that with companies like Mistral, which is being fully supported, not financially, but rhetorically, from the French government. And it won't be a surprise to see the bosses at Mistral at this event and featured prominently, because from the French state's perspective, that is an indicator of where they want to be headed. And so watching Mistral is going to be really interesting as well. They have that talent and they have the companies, and that company's raised hundreds of millions of dollars within about a 12-month time frame.
Yep. So maybe actually the narrative does change, because that event has certainly over the last few years felt like it's been a financial event.
Yeah.
And you can you can kind of understand why. We also got QEF coming up as well. We're going to hear from Janet Yellen a little bit later on as well.
Yeah, so Janet Yellen really interesting in terms of the tariff prospects coming through from the US, but also the debt questions that remain, and she's kind of nodded to some of those in recent weeks. So that conversation with Anne-Marie Horden is happening as well later today. That will be really interesting. And on the Middle East then, the QEF, so the Qatar Economic Forum 2024, kicks off in Doha tomorrow. We're going to be speaking to a host of global political players, such as the Qatari, Polish and Malaysian prime ministers, the Saudi finance minister as well, and the governor of the Turkish Central Bank. And we're going to get more on those US-China relations, as we've touched on and flagged. The question marks about China's overcapacity. China says it doesn't have overcapacity issues. It says it's, quote-unquote, being overhyped. What will the Treasury Secretary, Janet Yellen, discuss and talk about when it comes to that question? That exclusive conversation then at 3 p.m. UK time, guys.
Which is fantastic, because we've got so much to listen to over the next 24 hours, 48 hours, as we start to build up towards that CPI print. Be interesting to. I think the French story is really interesting. I wonder where the focus is going to be. We're going to hear from David Solomon a little bit later on. The Yellen conversation as well. But ultimately, we are just marking time. We are waiting for that CPI print to come out Wednesday. That's what the market's on tenterhooks about.
Indeed, and are we going to see more of a reaction if it goes one way than the other?
Are we going to see some explanations, do you think, out of some of these Bank of England members about why they voted the way they voted?
I'd like to hear from Dave Ramsden, if he's listening. I'd like to know why he dissented for this time. And is he being punished by the governor for dissenting, or is he actually being the sacrificial lamb, a signal to the market?
Just a stalking horse, maybe, in terms of the policy that we are maybe looking for. So we've got Hugh Pill speaking a little bit later on as well. We'll be hearing from him. It is an absolutely action-packed week in terms of the interviews that we are going to be bringing you and some of the names that are going to be speaking this week. So all of that is going to be folded in to the data story that we're going to be watching so carefully. It kicks off a little bit later on today with the New York Fed inflation expectations survey. We then get into PPI, then get into CPI, then get into retail sales. It is a week that you're not going to want to take your eyes off. We've got it all covered. That is what the markets look like right now. We're waiting, we're watching. We're going to pick up with the pulse next. That wraps things up for us. This is Bloomberg.